What is happening, people? It is your boy Jack, and today I'm coming at you with a really exciting video, one that I am excited to make. We're going to be trying to answer all of the questions you as a beginner may have in regards to the stock market. We're going to cover everything from what actually is a stock, where do you buy them, how much money do you need, how much money can you make, and pretty much everything in between. I'm going to try to cover as much as I possibly can in this video, but if you still have any questions after watching it the whole way through, please drop me a comment. I'll make sure to get back to every single one of them. I want to help you guys understand more about what the stock market actually is. And if you get anything from this video, please leave it a like. It helps me out big time, and subscribe so that you never miss any in the future. But anyway, let's get straight into this. I'm excited for this one. So the very first question, what actually is a stock? Because some people simply don't know. They just know it's something that people buy and sell. Right, let's say you want to get into the market. When you go ahead and buy a stock, what you're actually realistically doing is you're buying part ownership in a company. So let's say, for example, you buy a share in Walt Disney. The people who own Disneyland, Mickey Mouse, and everything in between. You actually own a very, very, very small amount of Disney now. So let's say you go to Disneyland with your friends, you can say, you know what? I own a part of this. And you do, a very, very small and incomprehensibly small portion of it, but you actually own a part of the business. So you're not just buying a stock, you are giving them money in exchange for part of the business. So that way, if the business grows, the stock price will more than likely grow and your investment will grow. I think that's a pretty cool thing to be able to say, even if it is the smallest amount humanly possible. If it's less than 0.0000001%, you still own a very small portion of a business, which is cool. Just the other day, I was in the shop with Sophie, my girlfriend, and we saw shoes made by Caterpillar, and I was able to say, I own a part of that shoe, because I own a part of that company. So from the get-go, that's really important to understand. When you buy a stock, what you're realistically doing is you're investing in a company. You're not just buying a stock that costs $60 or $70 or $1,000. You're investing in a company. I think the next logical question, and the second thing we want to speak about, is how do you go about buying a stock? But before we can even think about that, we have to ask the question, where do we buy a stock? And where we buy stocks is on the stock exchange. The most popular one being the New York Stock Exchange, NYSE. I want to make this as simple as possible. I don't want to make it too complicated. You've all probably seen The Wolf of Wall Street, okay? And you know that they were stockbrokers, like they were making people buy stocks, and that's how they were making all their money. Imagine, right, you're just in a room like that, and there's loads of people in suits, and they're all walking around. Let's say everybody has pieces of paper, okay? And these pieces of paper represent the stock. And let's say I'm here and I'm holding this piece of paper and it represents one stock of Disney, and I go over to a fella and I say, hey, would you like to buy this for $100? And he's going to have a think and he's going to say, yeah, you know what, that sounds like a good deal to me. So what I'm doing is I'm selling him my share for $100 and he's paying me $100. And that is exactly what the stock exchange is. You are buying a stock off of somebody else. If you decide to buy for 80 and somebody's selling for 80, you are essentially taking that stock from them. So people are exchanging these stocks every single day, well, Monday to Friday, 6.5 hours a day. That is what the stock exchange is. It's where you buy and sell stocks. So that's where we buy stocks. Now, how do we go about buying stocks? And there's actually a few different ways to do this. So the first thing you can do is, if you're somebody like me who wants to choose your own stocks and choose how much you invest in individual stocks, you can just go onto, there's loads of apps. I live in Europe, so the app I'm using currently is Trading 212. It's commission free, which is the first one in Europe to be commission free. If you're in the likes of the US, there are better options such as Robinhood and M1 Finance. But these are essentially just websites where you have free access to the stock exchange, and you can choose exactly what stocks you want to buy and exactly how much money you want to put into them. Nowadays, it's so simple. I can go on, and if I want to buy a stock, let's keep using Disney as an example, and let's say right now I think it's $82. Let's say I just want to put $40 in. You can actually purchase half a share now. Back in the day, you would have had to purchase a whole share or maybe 2 shares to even get a company, whereas now there are things called fractional shares. So it doesn't matter how much money you actually have, no matter, even if you only have $10 or €10, you can still invest in nearly any company in the world. So how we buy stocks, we sign up to one of these websites, we make an account, we get verified, we put in our information, we make a deposit, and it is literally as simple as just clicking the buy button. Now, alternatively, if you don't want to choose the stocks, if you don't know where to begin, if you don't trust yourself to choose the right stocks, you can pay stockbrokers to do it for you. So you can pay somebody to create a portfolio for you. This is available all over the world. Now, obviously, what's the downside here is that you're going to have to pay these people. You're going to have to pay them fees. They're going to take a percent of how much money you make, or even if you don't make money, you're still going to have to pay them. So that is the trade-off. Obviously, these people are professionals. They probably know a lot more than you, and a lot of the time they probably will make more money than you. But it depends what you want to do. It depends if you, like with me, I love the stock market and I really love doing the analyzing and I love looking into it and staying up to date with the news. That's almost the most fun part for me. The money is a bonus, but I actually love staying up to date with what's happening. Whereas if that's not for you, if you're really busy, if you don't have time to analyze these stocks, if you don't have time to make informed decisions, you can pay somebody to do it for you. And next up is one that a lot of beginners will ask themselves, because oftentimes beginners may not have an awful lot of money. They don't have a lot of disposable income, and they're wondering, is it even worthwhile starting to invest? And my answer is more than likely yes. You don't actually nowadays need an awful lot of money to get invested because of what I touched on in the last clip, fractional shares. So say for example, again, you want to buy a share in Disney and currently it's $80, you only want to invest 30. You can go buy $30 worth of a share, which is awesome. It means you're not confined to certain companies that are relatively cheap. You can invest in anybody. You can decide to invest €100 or dollars in pretty much any company. So how much money you need? It really doesn't matter too much. My main advice would not be to make a once-off sum. My advice would be to be able to save a certain amount on a weekly basis and to continue investing on a weekly basis. It does not matter how little that number is. For me personally, I only planned on investing 125 a week at the beginning. I'm not even a month in and I've over 3 grand in my account somehow. Don't ask me why. It's because this stock crash has made me become very aggressive with whatever money I had left on the side. But relatively soon I'll be going back to investing probably 200 to 250 a week. It just depends on where your investments lie, on where you are putting your extra money. With me personally, I'm also saving for my first house, so I don't want to put all of my money into the market. But short answer is you don't need all of the money in the world to get invested. So what I'd say is, if you don't have an awful lot of money and you're still thinking about getting involved, you can. Obviously don't expect to make much money if you're only putting 10 or 20 euro into the market, but it can be okay to open an account, put in a very small amount and just get used to how it feels to buy and sell certain things, and just get used to being in the market. But again, my main advice would be to put away a sum that you can every single week and invest every single week, because that's how things are going to add up. Now, why should you invest in stocks? Why should you put your money out into a market where you can lose money, as opposed to just leaving it sitting in a bank or a credit union where it's not really going to make any money, but there's no way you can lose money? That initial statement just answered it. It's because if you leave it in the bank or credit union, you can't make anything. In the stock market, historically, you will make money. After accounting for dividends reinvested and accounting for inflation, you make an average of 7% per year in the stock market, and that does not sound like a lot, but if you are leaving that money in there for 20, 30, 40, 50 years, the compound interest becomes absolutely incredible. It is absolutely crazy, and I'm going to show you examples now of how crazy it is. So guys, now we are on a compound interest calculator website, and I'm just going to show you how crazy things can get. Okay, so my current principal, let's just say I have 3,000 invested. Okay, that's what I have invested. We'll do one based on me. Annual addition. Let's say I'm going to get to a stage where I really would like to save 1,000 a month. So my annual addition is going to be 12,000 euro. Okay, my years to grow. Let's say I want to leave it in there for 50 years just to see what happens. Just to see 50 years. The interest rate on average is 7%. Okay, over the long term in the stock market, you can expect a 7% yearly return. Right? Make additions yet, calculate. So let's just see what I'll make in 50 years. I'll have just over 5.3 million, which is pretty crazy in 50 years. Now, how much of that will I have actually invested? I'm going to get out an actual calculator on my phone. 12,000 multiplied by 50. I'll have invested 603,000 and I'll be looking at 5.3 million. So I think you can see why I would rather be putting my money into a market that historically has shown a positive gain of 7% year over year, as opposed to just leaving it in a bank or credit union where I'm going to make nothing or maybe 0.5 to 1% of a gain. Obviously in the stock market there is a risk, and especially if you're a short-term investor, if you only plan on being in the market for 3 to 6 months, even a year, 2 years, there's a chance you will lose an awful lot of money. The longer you leave your money in the market, the more likely you are to make an awful lot of money. But you can see just how powerful it is when you are willing to be a very, very long-term investor. So in that last clip I spoke a little bit about dividends, and some of you may not even know what these are, and these are the stocks that I invest in, is dividend paying stocks. So what dividend stocks are is it's a company that pays you a certain percentage of your investment just for owning that stock. So again, let's speak about Disney. Disney currently have a dividend yield of 1.88%. So what that means is, say for example, I invest 100 euro in Disney, they will pay me 1.88% of that every single year. They pay it monthly or quarterly depending on the company. But essentially, it's money they pay you just for owning the stock. You don't have to put anything extra into them, they pay you. So even if they don't perform particularly well, you still get paid something of your initial investment. What makes this so amazing is that you get paid these dividends, you can put them straight back into the companies, and they will give you more and more dividends as time goes on because your investments are going to get bigger and bigger and bigger. It also means that when companies are performing poorly or the market is performing poorly as a whole, you still get paid something in the form of dividends. So even when your portfolio is going down in tough times like we're seeing right now, you're still going to be getting paid monthly or every 3 months by these companies. So dividends are powerful because every year it's like you invest 100 euro and say your average dividend yield is 3.5%. For every 100 euro you put in, you're getting an extra 350 on top of that. You reinvest that, the same happens next year, pretty much forever. It is crazy, and it's just free money that you get to invest back into the market. And again, the longer you're in the market, the more dividends you're going to get, the more free money you're going to get to put back into the companies, and it just compounds again, like in the last example. Now, not all companies pay dividends. They don't have to pay them. It's just something that they do when they make a lot of money and they want to give people an incentive to buy their stock. If you want to see what companies do or don't pay dividends, there's a website I use called Simply Safe Dividends. It's amazing. You can get a 2-week free trial just from putting in your email and creating a password, and you can look up pretty much any company in the world. You can see they have a safety score on there. You can see all of their earnings. There's so many useful graphs on there, and you can also see their dividend yield, their dividend growth the whole time they've been a company. So much useful information. It's a lot to take in all at once, but I really recommend you just checking out that website if you're interested in investing. Now, I want to speak about the different types of stocks that you can buy. So the ones I'm going to speak about predominantly are just your standard stock, one stock, so one company. So again, Disney, that's just one company and you can buy a share in them. There are also things called index funds. Okay, so over here we're going to have the S&P 500, the most well known, and it consists of over 500 companies. You can buy one share and you will have part ownership in over 500 companies. Now, is one better than the other? Does one have more potential? Is one safer? We'll speak a little bit about that. So I spoke about that 7% average return, and that comes when you look at the S&P 500. That is what people consider to be the market. That's the market standard. That is what we speak about when we talk about the market's average return, is the S&P 500, and that has historically shown a 7% gain. Now, why I like to choose individual stocks is because you have the potential to see much bigger gains. Now, you also have the potential to see much bigger losses, or no gains at all, or just perform better or worse. But essentially, I just prefer being able to choose my own stocks, not have to invest in 500 all at once. Now, these index funds, they're really good if you just want a safe bet and if you don't want to have to do all of the research. Again, they historically show 7% gains a year, which is still amazing considering that, again, in the bank or the credit union, you're going to be making next to nothing. But why I like to choose individual stocks is there is so much more potential. There's certain stocks in this world, there's certain companies in this world that have incredible potential and that have shown amazing growth as time goes on. And I would just prefer to put my money into these companies that have bigger potential than spreading it between really, really safe ones that aren't doing very much, some really risky ones. I just like choosing my own stocks. Now, this really just comes down to you as an investor and what you want to get out of your investments. You want to play it safe and not have to do any research? Well, then an index fund is probably for you. But if you want to do the research and you want to be in charge of your own stocks, then individual stock investing is what's going to be for you. And this is honestly the option that I think is the best, is the individual stocks, as long as you are willing to do the research, stay up to date on the news, and be diligent with your investing. Don't just invest blindly. You also could hold a mixture of both. A lot of people do this. A lot of people will put half of their money into an index fund like the S&P 500 and half into individual stocks. And this is another nice way of diversifying, so making sure that your portfolio is well rounded. You're invested in 500 companies over here in half your portfolio, and then you choose the other 50% over here. This just comes down to your time management, your risk management, and really what you think is going to be best for you in the long term. I definitely think that investing in individual stocks shows better potential, but it also shows more risk. Now, next up, an exciting one, a juicy one. How do you decide which companies to invest in if you're going to be an individual stock picker? What I personally believe to be the most important thing is that you invest in companies that you personally understand and believe in. There's no point in investing in a company that you don't understand. Say, for example, you look at Disney. Everybody somewhat understands Disney. You know, we know they have these parks. We have Disney Plus coming out. They make cartoons. We all have a brief understanding of them, okay? Whereas if you go into something, if you have no idea about oil or anything to do with oil stocks, you don't have the slightest clue on how oil works, on how its price works, it's not going to be a very smart idea to invest in any oil related companies, because how are you going to believe in them if you don't understand them? And again, Simply Safe Dividends is an excellent website for figuring this out. You can go on there, they have a screener, you can find stocks that fall underneath kind of what you're looking for, so things like their dividend growth, their dividend yield, how they're doing, their dividend safety, things along those lines. That can give you a brief idea of what you're looking for, and then you have to go into a bit more research. So let's say you figure out a company that you believe in, that you would like to invest in. Well, you can't just invest in them because you like them. They have to be a good company, they have to have good fundamentals, and they have to, you know, have the cash and the sheets and everything to back it up. So where do we see this information? Where do we see if they're actually a good investment? So the first things you want to go look at, and this is where things get a little bit tedious and you have to actually become an investor and research in the company, is their 10K and their 10Q, okay? So a 10K is basically a company's reports on their earnings over the last year, and a 10Q is over the last quarter, okay? So this is where you can go see
everything that is happening financially with any business. They all have these. Other things to do is keep up on things like the news. Usually you can listen in on certain companies' conference calls. You can see what their CEOs are doing. They usually have Q&As. CEOs are always in the news, are always at the front of the news. Like, you will be able to find out as much information as you are willing to on these companies, and this is where research becomes so important, because not only do you have to believe in them, but they have to have a strong business model. So now you've looked at the 10K, the 10Q, you've looked at a few interviews with their CEO, it's a company you understand and you believe in. Next thing we do is we start to look at like their balance sheets, their free cash flow, their earnings per share, everything to do with money, so that we can see if they're a profitable business and if we expect them to be profitable going forwards, because that is the most important thing. If a company doesn't do well, then your investment won't do well. It really is that simple. And that's why we are investors. We don't just buy a stock. When we buy a stock, we're investing in that company, and we have to believe in them, because if we don't, we're just basically throwing money away. If we don't believe that this company is going to do well in the future, why would we invest in them? And again, that just reiterates the point that you have to understand them and truly believe in them. Now, one very important one is, can you lose all of your money? And the answer is yes, you can. Now, it's extremely unlikely if you're a smart investor and you invest in the right companies, but you can lose your deposits. Now, if you're well diversified, if you're invested in 20, 50, 100 different stocks, they're not all going to go bankrupt. The only way you lose your entire investment is if a company goes bankrupt. That's how you lose it. So right now, let's look at one company that has a lot of coverage and a lot of uncertainty. Loads of people want to invest in them, me included, but we're not sure because there is massive potential they'll go bankrupt. That company is Carnival Cruise Line. So this company has dropped in price so much over the last month because of the coronavirus, the virus that's going around right now that has the world going crazy. And obviously, this is a cruise line. You know what I mean? This company runs cruises. That's how they make their money. People aren't going on cruises right now. The question is, can they survive this if it goes on for a year, 6 months, 2 years, whatever it is? Does this company have enough money to survive this? Will the banks bail them out or won't they bail them out? And nobody knows. That's what makes a company like this really risky. But they also have the most growth potential. It's that risk to reward ratio. The safest companies, they're probably going to make you some money, but nothing crazy. The companies like Carnival, you're either going to lose all of your money or make a tremendous amount of money. So I've done a lot of research on Carnival, and they are a company I truly believe in, but the one question that's left unanswered is, will they survive this financial crisis? Will they be able to get through the next 6 months to a year, or will they go completely bankrupt and will I lose all of my money? And that one question is the only reason I haven't invested yet. Now again, more than likely a company isn't going to go bankrupt as long as you choose companies that have been around for decades, 50 years, 100 years. Companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, they're companies that people, if they were to go bankrupt, it would be crazy. I don't think anybody could foresee that happening. But then there's companies like Carnival. There is potential for them to go bankrupt. They're relatively new and they're in an industry that's getting hit so hard right now, and nobody knows how long this virus is going to go on. So, short answer, yes, you can lose all of your money. If you're smart, you definitely won't. And my advice would be, if you can't afford to lose the money, don't invest it. And definitely don't invest it in a risky company like Carnival. I still more than likely will open a position on these, to be honest, a relatively small one. And if they go bankrupt, I lose all my money, I won't be too upset. It'll be a few percent of my entire portfolio. I won't be too upset.
Oh, I just realised the mic was plugged out for those last two clips. I really hope it wasn't too painful to sit through. I'm sorry, man. But anyway, guys, that's what I think the basics are when getting in. Now, obviously, as I said earlier in the video, if you have any more questions, please just drop them in the comments. I'll answer every single one of them to the best of my ability. Again, I'm not a financial advisor. I'm a random kid on the internet. But I just want to give you my advice as somebody who is new to the stock market. As I said, I'm only in it not even a month, man. I'm not even in it a month, baby. But I just want to give my thoughts so far on my journey. So again, if you did enjoy, please leave a like on the video. It helps me massively. Subscribe if you're new to never miss a video. And until the next one, guys, peace.